Hi, good morning. Welcome back to the channel Casting Off. This channel is about my journey towards getting away from home ownership and the general ties of bills and all that kind of stuff, and living a more nomadic lifestyle. To do that, I do need money. So I'm going to talk today about investing in my self-invested personal pension plan and how I've managed my pension plan to hopefully give me enough money to semi-retire or maybe even retire on hopefully next year when I'm turned 55. Now, when I talk about investing, I use Hargreaves Lansdown for my pension. I'm not affiliated with them at all. But what I did is I had a couple of private pension plans that I'd had with previous employers, and where I'd left them, I was able to then move my pension plan into a pot. I also had opted out of SIPPs back in the 80s. I don't think you can do that now, but I had a small lump sum as well of about 15,000, I think, which I moved over to my HL or Hargreaves Lansdown. I'll call them HL, my HL SIPP, which is my self-invested personal pension plan. The reason I've gone with HL is just because they give me a massive option of funds that I can play around with, lots of different stocks and shares options. Now, just to clarify, when people talk about investing in the stock market, some people may think, and I know I initially did, think, how do we do this? Is it a big risk? Is it costly? And all that sort of stuff. If you're investing in specific shares, like for instance, I don't know, Tesco, Apple, Netflix, all of which I've done in the past, you quite often have a share dealing cost, and with HL it's about 14 quid every time you purchase some shares in any company. So what I generally do now is I invest in indices. So where you have, best example I can think of is the FTSE 100 in the UK. The FTSE 100, which is the Financial Times Stock Exchange 100, is the top 100 top performing share prices of companies in the UK. So they are the top 100 companies whose share prices perform the best in the UK. And basically what happens is if someone's share price dives, if one of those companies' share price dives, they drop off the 100 index and then are replaced by another company that might have a better performing share price. That way it's less risky. So for instance, in the FTSE 100 you might have BT, you might have Tesco, various other big UK companies. So if you were to invest in just that company and then that company was to fold or have a real problem for some reason, some scandal hit the news or something like that, and their share price dived, that's your investment pretty much wiped out. Whereas if you invest in the FTSE 100, although it's not going to be as volatile and go up and down as much, so you won't get as many gains and you won't get as many losses, over time, because it's replaced and it replaces the bad performing shares, over time the price of the index should go up in value. And that's the idea with indices. So I also invest in American markets. I invest in the S&P 500, the Standard & Poor's Index 500, which is the top 500 performing, best performing share prices in the States. A lot of those are heavily weighted towards tech stocks as well. So, that'll be Nvidia, Facebook, or Meta, what else? Netflix and Apple, Microsoft, those kind of shares. Now obviously you can invest in those particular shares on their own. You'll have a share dealing cost each time you do it, and they can fluctuate wildly on their own, whereas if you have one of those might wildly fluctuate, whereas the index won't, so it will soften the blow. And that's why I invest all my money now in indices rather than specific shares. I have got some things in shares, but that's for a separate conversation. The bulk of my SIPP is invested in shares. So let's have a look at some real figures. Now, you'll see from the thumbnail, I have started investing again recently using a strategy called pound averaging or dollar averaging, and that has netted me, well, it's gained on my investments just over £2,000, 2,220 I think, in the last month approximately. So the gains are there. Stock market works if you do it right. Now, I've made some bad decisions, as I said in the past. What I had done is when Trump decided to put all these tariffs out, and the stock market dropped, as I'll show you. It dropped quite wildly, and I panicked, and I went against every little bit of advice that I would normally give out, or for myself, every little bit of advice that I would normally follow, or advice to family members, which was don't pull out, hold fire, it will go back up. As you can see, it has gone back up. Unfortunately, because I pulled out most of my investments, the classic happened, which is what I've always warned against, which is I've missed out on that growth. So I had about 105,000 in this particular pension. I've got another pension that I'm trying to get over the 100,000 mark, but that's a different story. The one in my self-invested pension with Hargreaves Lansdown is now about 82,000. It was 80, but it was originally 105, and I lost about 20 to 25,000 when that dip happened, and then I came out of the markets, withdrew literally the whole lot, stupidly, and missed out on the gains, which I probably could have gained back about another 20,000, and I could be back up to around 100,000 now. But hey ho, that's water under the bridge now. So basically what I've been doing is over the last 40 days or so, I've been putting £1,000 or just over £1,000 on average into these indices, these stocks and shares. So let's have a look at the specifics, and I'll go through exactly what I've been doing. So this is my SIPP, my self-invested personal pension plan with Hargreaves Lansdown. Let's go into my pension here. Right, so basically what happened is, as I explained, I pulled pretty much all of my money out of the market, and built it up to, I'd originally built it up to 80,000 from about 40,000 invested over the years, over about 8 years. So I'd averaged about 20% a year over 8 years. I think that's right. So what I've been doing, I've pulled most of it out. In fact, I pulled all of it out. I transferred some over to European indexes. So the S&P 500 I was heavily invested in, and I still am, again. But this drop here, see all those red lines going down, all those red candles, that was where it was plummeting. And there's a big gap where it gapped down as well. And I panicked halfway down there. I just panicked and just saw it going absolutely pear-shaped, and so I withdrew most of my against my good judgment and against my own personal advice, which I would always say to myself and family members: never ever pull out, just hold fire, it will go back up. And as you can see, it's gone back up here to pretty much more than it was when it started. So I lost 20,000 on this particular pension. I'd had it was just over, it was about 105,000, something like that. So I lost about 20 to 25,000. Pulled all my money out and could have gained about 20 grand back. But anyway, that's by the by. So what I started to do was invest in my SIPP. I started to put away £1,000 a day during weekdays, so Monday to Friday. I'll be putting 1,000 to maybe 2,000 a day into various stocks. So I've now invested 33,215 literally over the last month. So it's just over £1,000 a day. And then you can see on there the gain is £2,222 in 7.17% average. So that's the gain over the last month. So I've made £2,000. It's cost me 33 grand to do it, but that 33 grand has gained me 2 grand. Now, if that carries on each month, I'll have got my 22 grand or my 20 odd grand back by in the next sort of 10 months or so. It won't happen like that. It'll slow down. But if you can see on here, the Fidelity Index is the highest performing at 9.3%. So I've invested more in that. I'll probably take that down to about 30,000 and then keep 30,000 as cash, because I'm due to access the pension next March. So there you can see the worst performing one, funnily enough, is the FTSE 100 index, which is interesting. So, which is why you can see a lot of people don't bother investing in the UK. I've invested here in the S&P 500, the Fidelity Index US, that's pretty much US 500. Artificial intelligence, I think that's global. Global artificial intelligence is performing the next best, funny enough. Vanguard US Equity Index, again, that's another version of the S&P 500. And then Fidelity Global Technology, I don't know what they're investing in compared to Sanlam, but they're not as good. They're literally half. So I'll probably put more into the Sanlam one. And then, of course, you've got the FTSE, which I've put in there as a safe bet. But the FTSE really is a pretty crap investment if you want a lot of growth. It doesn't really grow very, very quickly compared to the American markets. So that's how that works. And going forward, what I'll be doing is, is updating maybe weekly as to how that's going. And I'll show you the total, where I've got the total gain or loss up there of 2,222. I'll show you how that goes up and down, which it will do over the coming weeks. But that's the idea. And the idea is to get this back up over 100,000. I've got other pensions elsewhere, which I'm trying to get over 100,000. So I'll have more than 200,000 when I decide to take the money. So that's the idea. I hope all that makes sense so far. So as you can see there, I've been investing, as I say, just over £1,000 a month, a day during weekdays, Monday to Friday. I've also been keeping an eye on the market, because if there's a trend where it suddenly shows that things are dropping off a cliff, and I'm checking the news and it looks the outlook looks bad, I'll probably pause what I'm doing, rather than and just wait until it bottoms out, and then I'll buy the indices in again at a really low price. That will be the idea. But yeah, I mean, if it carries on as it is, then in 10 months I could have 20 grand back if I keep investing that. But it won't pan out like that, because I'll run out of funds to invest with eventually, and I'll be then beholden to how the funds, each of the indices perform. But what I'll probably end up doing is weighting it towards the bigger gain indices. So I'll probably lop off the other ones, sell those out at a profit, and then reinvest back in the ones that seem to be gaining faster. It's a bit of a risk, because I'm not spreading my investments over European and English stocks, but I have found that I've always made a loss. When I've only invested in just the FTSE and European stocks, they're just too volatile. Whereas the American stocks, if they have dropped, have always gone back up. As I said, I just made that mistake where I withdrew because I panicked. But I'm starting to make some gains already. It hasn't taken long, and so that's the strategy going forward. So I hope that's been a little bit of a taster on what I'm doing, why I'm doing it, and I hope to keep you updated on that. Things will fluctuate, I know, but I'll show you how my strategy will change over the coming weeks, and hopefully we'll get back to a decent lump sum that I can access then next year when I turn 55. So if you are interested in managing your own pension funds or managing your own SIPP with whoever you're with, then please consider subscribing to the channel, because I'm going to be doing updates every week as to with real numbers and real screenshots to show you how my investments are going. And in the meantime, if you enjoyed this video, please hit the like button. In the meantime, appreciate you watching. I'll see you soon.